So welcome now to the Young Economist session. I have three bright young scholars flanking me here from both sides of the pond. And we will start with Alexander, after that Ethan, and last but not least Chiara, who actually, for anything that she's going to say that's wrong, I'm to blame because she was one of my former trainees. So I'm very much looking forward to her talk here today. Now, so the rules are 15 minutes each, and then a couple of minutes for Q&A. So we go one by one. And please ask questions. So, Alexander, the floor is yours.
All right, thank you very much. So I'm Alexandre, I work here at the ECB, and first I would like to thank the organizers for putting the paper in the program. And so the papers joint work with Emmanuel Gastegayer, Alex Grimaud, Gauthier Vermondel, and with Guido, who's in the room. So if you have any difficult questions for him, I think he will be happy to answer over the lunch break as well. And so since some of us work in Eurosystem central banks, the usual disclaimer applies. And so the paper is entitled Monetary Policy in the Euro Area when Phillips curves occurs. And so the motivation for the paper is the following. So before 2020, there was a relative consensus that the Phillips curve was flat and quite linear. And what that meant for us, practitioners, was that typically when we estimate our favorite or calibrate our favorite sticky price, sticky wage model, we tend to use what we call the high Calvo parameters. What it meant, in other words, is that we were going to assume a constant, relatively high parameters for the frequency of price and wage adjustment that was going to lead to infrequent changes in prices and wages, and that was in turn going to lead to a slope of the Phillips curve that was rather flat. And this had implications in the sense that typically, even if it's, let's say, solved in its nonlinear form, the standard sticky price, sticky wage framework was going to be close to linear and state invariant, such that the shocks and the transmission of those shocks were going to be non-state sign or sign dependent. So in particular, we didn't have any features such as the fact that large shocks were going to travel fast for supply shocks, nor the fact that, for example, monetary policy state was going to be state dependent. So the transmission of monetary policy was broadly state invariant. And so since 2021, so both assumptions were actually challenged. By both assumptions, I mean the fact that macro evidence pointed to non-linearities in the inflation dynamics. And the second one was that there were micro evidence showing the fact that as inflation increased, the frequency of price and wage adjustment was going to increase as well. And so that's where this paper comes in. So our goal is to connect those macro nonlinearities, and in particular to look into the role of endogenous price and wage adjustment frequencies. And in particular, our goal is to look into that question and to understand the impact that it had for the euro area over the recent inflation surge, and in particular as well for the state dependence effect of different type of shocks, as well as the way the inflation output trade-off is going to change for monetary policy. And so we do that in three ways. First, we build a framework based on some work from two of my co-authors that is going to be a non-linear new Keynesian model with endogenous price and wage adjustment frequencies. Second, we're going to take that model to the data and use a non-linear Bayesian estimation for the euro area using an extended path and an inversion filter. And finally, we're going to look into, so to use that model in order to look into some quantitative analysis for the recent euro area inflation surge. And in particular, let's say the message that I'm going to try to convey in the following 6 minutes is that there was a role for both price and wage state dependency to the recent inflation dynamics, and that also those factors change the way shocks actually transmit, and hence the stabilization trade-off for monetary policy. And so in terms of the model, I will be light on equations. So it's really just a standard new Keynesian model where we have a representative household, a Taylor rule, and really the the core of the mechanism is going to come on the price and on the wage side. So on the intensive margin, this is just as well standard. So we just assume that there's going to be firm and unions that choose the optimal reset price and wage. But the key novelty here, the key difference that we introduce is really on what we call the extensive margin. So typically in a model, you will have a Calvo as a parameter. What we do is that we assume, we construct a model where there is an endogenous share of non-resetting price and wages that comes from this complicated logistic functions that actually only has two main inputs. The first one is what we call the value of resetting prices, that is V sharp here. And this is going to be compared to the value of keeping the price to the old aggregate price or wage. And basically, as the difference between the two is going to increase, you're going to have more incentive to either keep your old price or change it. And that's the way we actually make the frequency endogenous. There are two key parameters. Let me focus on one of the two. So this gamma z really scales the extent to which you have state dependency. So as this parameter increases, the difference between the two will matter more for the frequency of price and wage adjustment. And as this parameter goes back to zero, then the model collapses back to an environment where a price and wage frequency are going to be fixed to a value. And so that's on the, let's say, frequency side. What does that mean in terms of macro variables? So why do we get genuine nonlinearity in the Phillips curve that we obtain? So this is really coming from the fact that we get, let's say, the standard Dixit-Stiglitz CS aggregator generate a strong asymmetry in the profit. So the key takeaway is really here that there is a large opportunity cost to being underpriced in that model and more than to be overpriced. And what it means in terms of, let's say, shock transmission is that so in all states of nature, whether it's demand-driven or supply-driven, as long as inflation increases, firms and union in this case are going to have a strong incentive to update their prices or wages. And so that means that there's going to be an interaction between this intensive margin of price adjustment and the extensive margin of price adjustment, which is going to increase in a non-proportional way as price and wage inflation rises. And so finally, that means that Phillips curves are going to be genuinely curves, and as inflation increases, we're going to see responses to shock. They will exhibit state, size, and sign dependency. And so now what we do with the model, we take it to the data, and we do that in a nonlinear way, and we're going to compare different versions of the model in order to run some counterfactual. So the goal will be to look at version of the model where the two, let's say, features that we're looking at, so the state dependency in price and wages will be turned on, and versions where either the two or one of the two is going to be turned off. And so we do so in a fully nonlinear way in order to capture the mechanism that is at the core of our paper with the following solution methods. And then we estimate the model using EURAREA data from 1999 Q1 to 24 Q4. And we do find in a paper that the benchmark model, so the one where we have endogeneity in price and wage adjustment, can actually outperform the standard Calvo price, Calvo wage model. And now moving to the results. So here we have 4 different curves. So the blue one is really what we call the benchmark. So that's the data that we filter. That's where the both margin are going to be turned on. So the frequency of price adjustment is going to be endogenous. The frequency of wage adjustment is going to be endogenous. And here the key really is to see that if you compare that blue curve to the other curves, so the red one is where price is turned off but wage is turned on. The yellow one is where the two are actually turned off, and then the purple one is where we only have prices. Then in this case, we see that before 2021, there's basically no difference. So even though we allow for price and wage adjustment frequency to be endogenous, both Phillips curves are actually going to stay rather flat. And then most of the action actually comes in after 21. So in this case, if you focus on the bottom left chart, what we call the Calvo share, that's really in the model the frequency of price adjustment, and you see that there is a difference between the benchmark in blue and the purple case in the purple line, which is the case where only the frequency of price adjustment is going to be turned on, and we see that there is a persistent decrease in the fraction of non-resetting prices, meaning that more firms are going to update their prices. That's going to lead to a steepening of the Phillips curve. And now in terms of macro effect, you can see that on the top right, in the case of inflation, that's really this frequency in price adjustment that is going to, let's say, lead to that inflation increase that we see in the data, much more so initially than once we only include wages in this case. And then, so that's mostly, so the initial kick in inflation is mostly driven by the fact that price reset are going to be endogenous. And then the wage, they're going to play a role towards let's say the final 2 years out of 23, and we see that there's a somewhat reinforcement of the real wage catch-up via the fact that the frequency of wage adjustment is going to increase as well somewhat in the final 1 minute. So that also means that now there's going to be state dependence in the transmission of shocks. So what we do here is that we initialize in each point of our sample the economy to the state at which it is, and then we shock with always a normalized either cost push shock or monetary policy shock, and we look at the transmission. And what we see is that when the inflation state is higher, so that's for example the case of the 2022 Q1 curve here in blue, then the impact of the supply shock is going to be stronger compared to normal times. It's also going to be the case on output. And so finally, in terms of monetary policy, we also see that the same mechanism apply in the sense that as the Phillips curve is going to steepen due to the extensive margin, then monetary policy is going to lead to a stronger disinflation for, in this case, a smaller output loss. And so finally, in terms of the trade-off faced by the policymaker, that means that as inflation increases, so what we call the trade-off here, meaning the ratio between the impulse response of output and inflation, as this number goes down, the cost of disinflating actually goes down as well. It's less costly for the central bank, and we see that as inflation increases, this also decreases as well. And with this, I will conclude. My time is up. Thank you very much.
Thanks, Alexander. Also for sticking to the time. It's hard, huh? 10 minutes.
Short.
That's what we need to do upstairs as well. So, questions? Just very short questions. First, Oreste here.
Thank you. Very nice, Alexander. I just wanted to ask, or maybe even suggest, you don't need to answer it, there's no time, but it would be interesting to see, you haven't said what data you use in the estimation, but it would be interesting to see how fast in the estimation in real time you can capture this change in your indicator of price frequency. So, you know, for example, in the episode that you suggested, whether it moved fast enough to be detected again in real time, or whether you need to wait, for example, until the end of the inflation period to understand that.
Good. Okay.
Okay, so the evidence, well, the results you have shown suggest that prices became more flexible during the recent surge in inflation. An alternative evidence that you have seen in previous papers is that monetary policy became less responsive to inflation. The two will both lead to, you know, a less effective monetary policy. And is there a way through the lens of your model to distinguish these two stories?
Great. Okay, Alexander.
So thank you very much for your two comments. Very well taken and excellent points. So on Oreste, on your comments on the data, indeed, I was a bit too quick due to the time constraints. So we use four variables, among which both wage and price inflation. In this case, what we see is that, so the variable that actually matters for the model is quarterly inflation rates. And we see that as soon as that variable is going to deviate substantially from, let's say, the steady state that we have, so the 0.5 steady state that we have in the model for this, then the frequency is going to change. However, so that's not only the size that matters, but also the, let's say, the persistence of the increase, of the potential increase. So we will typically find that, let's say, as inflation goes up, already, let's say, if we get a push of like 1% at the quarterly level, we'll see already a difference in the frequency of price adjustment, and that will translate into a steepening of the Phillips curve. And that lasts for as long as inflation is above target, and therefore endogenously, as inflation goes back, let's say, closer to the quarterly target, then in this case, we see that the nonlinearity tends to disappear. We also compare those numbers with microdata that we got from Prisma. It's more or less aligned. Maybe the scale is a bit higher in our model, and I think we have a very tiny difference in terms of the timing, maybe 1 quarter, but most of it actually follows through. So on the question the response of monetary policy, it's a very good point. I mean, we have not implemented it in the model, so the way we actually, let's say, model the Taylor rule is via a standard linear Phillips curve where the parameter responding to inflation is fixed. But I do believe that there probably is a way for us, since everything is nonlinear, to look into it further and to potentially allow for either change in the regimes or something else such that we can potentially capture it. Because for sure, as you said, that also plays a role in the way the shocks are going to be transmitted at a later stage. Thanks very much.
Thanks, Alexander. That was great. Okay, Ethan, you're up next. All yours. Can we please pull up Ethan's slides? You can just read out your disclaimer.
Yeah.
That's the first thing you probably have to do.
So thank you for having me. The Federal Reserve Bank of Boston, so the usual disclaimer applies. Okay, so the motivation for this paper are the high public debt levels in the US, the EU, and around the world. I've given you a couple of examples here, but there's many others. Now, this debt also tends to have a low interest rate, relatively in this R less than G sense or in comparison to other assets. Now, the previous literature on optimal debt policy focused originally on expenditure risk and saying, well, there could always be some crisis in the future, so we should get ready for that today by lowering the debt level of the country. But a more recent literature has instead focused on these relatively low interest rates and the convenience yield on US debt and said, well, actually, maybe you can have really high debt instead. So these two literatures give completely opposite answers. One would emphasize expenditure risk is important. In fact, countries should have negative public debt in that world. They should act like a sovereign wealth fund. And this recent literature says you can have as much debt at like very high levels. So the research question in this paper is, if the government issues safe assets, what is the optimal debt target that a country should be aiming for? And also, how should they respond to expenditure crises, given that these are safe assets that they're issuing? Additionally, I ask, now how does this optimal policy compare to the actual policy of the US in particular? So to answer these questions, I'm going to build a quantitative debt model. So this is going to be an environment that features uninsurable fiscal disaster risk. So these are huge expenditure shocks. World War II can happen. Okay? You're going to have risk-averse households that are going to be willing to buy the debt from the government, but they also demand liquidity. Now, governments are going to be able to issue these safe assets that are both risk-free and provide liquidity to households. But the government, to repay this debt and roll it over every period, is going to rely on either distortionary labor taxes or what I call liquidity taxation, that is, interest rate suppression or debt seigniorage. In other words, if they deny markets the liquidity they want, they can keep the interest rate artificially low, and that is some form of tax collection for the government. Now I'm going to externally calibrate this model to our standard parameters, which I'll show you in a couple slides. And then I'm going to calibrate the expenditure risk to match the history of US expenditure. I'm going to solve for the optimal Ramsey policy, and in the paper, I present first-order analytic approximations of the ergodic distributions, as well as global numerical solutions. So I find that liquidity demand is going to amplify the debt financing of governments during expenditure crises, and it's going to lead to a positive optimal debt level. I'm also going to show that this optimal debt policy actually closely approximates the history of US debt policy. So to put some numbers on this, I'm going to find that the optimal debt target during peacetime is 65% of GDP, and that the optimal convenience yield or liquidity tax is 67 basis points. So as a preview of the results, here I'm plotting the actual history of debt and primary deficits in the US, and then the optimal policy with a model with and without liquidity demand. So to be clear here, this is an externally calibrated model. I didn't set this to try and match the history. It just happens to closely match it. Secondarily, the only forcing variable here is expenditure. So in a model without liquidity demand, expenditure risk is so powerful that it drives the optimal debt levels to 0 in pretty much every period. Whereas once we include this demand for liquidity, the model pretty closely approximates many periods of the US. Okay, so I don't have time to present a full model and go through all the equilibrium and everything, given the short presentation. But here is the household's utility function. So everything in black is sort of our standard McClure preferences, all right? And the main term here that is different is this term in blue, a demand for liquidity by households. So here I have a representative agent in the paper, but there's a variety of microfoundations that you can use to get this sort of demand for liquidity, bonds, and utility function in a representative agent model. So I'm going to calibrate the model to our standard IES, Frisch parameters, and then importantly, calibrate to this demand for liquidity from Krishnamurthy, Vissing, Jorgensen. I have some other calibrations I'm going to show at the end to alternatives to these, in case you have some other standard parameter you like more. But these are a good starting point. Now, for the expenditure risk, I'm going to have a two-state Markov chain that's either going to have a peacetime level of about 20% government expenditure, and it can go as high as 45, and then there's noise around both of these. And these are going to be persistent states. So a crisis occurs every 20 years and lasts for 4 years. So in some sense, this is a very conservative estimate of expenditure risk. Like disasters happen a lot and they last for a long time. So policymakers should be concerned about them. Okay, here I am plotting the optimal policy targets. So the experiment here is you start with 100% debt to GDP and you experience a long period of peace. In any given period, a war could have broken out, but it didn't. So there was always this fear, and the expenditure risk is present the whole time. But you happen to stay in the peacetime the whole period. So without liquidity demand, you can see the optimal debt policy is immediately negative. And in fact, this will keep going for quite a while. The expenditure risk is so strong a force in the models that you want to just have a sovereign wealth fund and have a ton of assets. Now, with liquidity demand, we're going to pretty quickly converge to 65% of debt to GDP. We're going to end up with a lower interest rate than a model without liquidity demand because the government here issues an asset with a convenience yield, which I call the liquidity tax. This is about 67 basis points here. But you're also going to see that you have a higher optimal labor tax rate. This is because the government has to fund this high debt position it's holding all the time. All right, so let's say you've been in peace for a long time and suddenly a crisis emerges. So this is a huge crisis. This is a war the size of World War II for 10 years. But this is to give you a sense of the movement of the variables. So as you can see, debt, taxes, interest rates, and output all rise in response. But having a demand for liquidity is going to amplify the effects of debt and taxes, especially. And actually, there's a fall in the liquidity tax during this crisis period. There's a fall in the convenience yield. But this is mechanical because the debt is increasing here, and thus the marginal value of liquidity is falling for households. They're getting all the liquidity they want as the market is filled with debt. You may wonder why there's spikes at the starts and ends of these wars. So if we had complete markets and the policymakers had access to lump sum taxes, they would want to have lump sum taxes during wars and a lump sum transfer at the end. And they're trying to mimic this with their taxes and interest rates, which is why we get this spiking effects at the beginning and ends. Because they understand at the start of a war, it's going to last for a while, most likely. Okay, so let's zoom in on a recent policy. So here I'm starting in the year 2000 and having the model restart with the same debt to GDP ratio there and asking how does actual debt policy compare with optimal. I also have here in gray the CBO projections of debt to GDP as well, given, and then the optimal policy given the CBO's projection of expenditure going into the future. Now, as you can see, the model would say that policymakers should increase the debt during great financial crisis and COVID since they're spending so much, but they spent too much in the view of the model. So about 15 to 25 percentage points in each of those two crises. But the biggest difference here, and this is since 1940 where I showed you the model earlier, is the CBO projections into the future. If the US were to continue on its projected path, then by 2035, they would be 50 percentage points off from optimal. Because in the model's view, this is a period of peace, expenditure's low, they should be running the debt down. And that's not what the projections say. All right, so with 10 seconds left, I'd like to just show this graph here. So these are some alternative calibrations I'll leave up. If you wanted to think about a different model, a different way to calibrate your liquidity demand, or different ways to calibrate your various macro parameters, I've presented them all here. And these are presenting the mean, median, standard deviation of the debt, optimal debt, as well as the target, and the upper debt limits that you would have. So with that, I conclude. I'm out of time. Thank you very much. Look forward to your questions.
Thanks, Ethan. Well done. First question goes to Bartosz.
Bartosz Maćkowiak, ECB, great paper. So the demand for liquidity may be changing over time. There may be some high-frequency movements, for example, during a financial crisis, and there may also be some secular trend. You know, as GDP grows, as the financial system becomes deeper. Can you include these factors in your model? And what would happen? What would the model predict?
Okay.
Any other question?
Okay. So I have a section in the paper with stochastic liquidity demand like this, where I fit the history of US convenience yield, which has moved around. So treating this as like an AR1 process, kind of like Kekri and Lennell's paper, I find, yes, that like in response to a sudden demand for liquidity, this is actually great for the government because suddenly their debt is cheaper, they can issue more, they can lower their interest rates and lower taxes all at the same time. I actually have a slide in here on that, but yeah, I explore this in the paper as well. And this would help rationalize some of the recent debt as well.
Great. Maybe in terms of the motivation, I hope you get this published very soon if it isn't already. That this, R being lower than G increasingly is not really the case anymore in some of the countries that you mentioned, just for you to be aware. Okay, good. Then we are ready for you, Chiara. All yours.
Okay, so thank you so much to the organizers for including our paper in the program. I'm very happy to be here and to present this joint work with Michele, Natalie, and Paolo. And since Natalie is at the Bank of England, the usual disclaimer applies that this does not represent the view of the Bank of England, but only of the author of the paper. Sorry. Okay. So in this paper, we start from a standard question in macroeconomics, that is whether the best way to stabilize business cycle fluctuations for the central bank is to stabilize headline inflation. And in the canonical new Keynesian model, this result is obtained because when prices are aggregated using sectoral expenditure shares, headline inflation is the sufficient statistic that summarizes all the relevant distortions in the economy. However, this result in the canonical new Keynesian model is obtained by implicitly assuming two things, at least. First, that the demand cyclicality across different sectors is the same. And second, that the share of income that accrues to hand-to-mouth households across different sectors is the same. However, we see that in the euro area, these assumptions are violated in the data. So in particular, we focus on discretionary goods and services. These are these goods and services whose budget share increases with income. So the goods and services that we consume, the more, the richer we are. Think about, for example, going to the restaurant, going on holiday, or purchasing a new car, as opposed to necessity goods and services, that are these goods and services that we consume the least. As a share of our income, the richer we are. So in the euro area, we see that these goods and services, the demand of these goods and services is more cyclical along the business cycle, and that the sectors producing these goods and services employ a larger share of hand-to-mouth households. So we incorporate these empirical facts into an otherwise standard new Keynesian model. In particular, we introduce non-homotheticity in the demand and labor force heterogeneity. And we revisit the question of whether is it the best way for the central bank to stabilize aggregate fluctuations by responding to headline inflation. And the model delivers two key insights. First, in the welfare that we derive in our model, the output gap has a larger weight relative to what previously understood with rank models or model with just heterogeneous agents, but without the combination of our two key features. And second, in our model, the central bank can improve welfare and so stabilize in a more efficient way the business cycle if it responds more strongly to inflation in discretionary goods and services. And this result holds even if the shocks that hit the different sectors are symmetric, and even if the nominal rigidities across the different sectors are the same. So this is a bit more in detail the intuition of what is going on in our model. So imagine there is a negative shock to household income. Households start cutting consumption. But I will show you soon empirically that they do not cut consumption equally across goods. They cut first discretionary consumption. And by doing so, they hurt the income and the employment of the households working in the sectors producing these goods and services. But again, I will show you empirically that these households are more likely to be hand-to-mouth. And so through these hand-to-mouth households that have a high MPC, the initial cut in discretionary spending now transmits to necessity spending, leading to a second drop in aggregate demand and to an amplification of the business cycle. And so if the central bank responds more strongly to an initial change in discretionary prices, it can prevent this amplification to happen and better stabilize business cycle fluctuations. So this is what the data looks like. So the black dashed line is aggregate consumption growth in the euro area. The blue line and the red line are discretionary and necessity consumption growth in the euro area. And the shaded areas are euro area recessions. So as you can see, discretionary consumption drives the fluctuations in aggregate consumption in the euro area, because every time there is a recession, there is a drop in discretionary consumption. Every time there is a boom, there is an increase in discretionary consumption, while we don't see the same pattern for necessity consumption. And in the paper, we do a lot of effort to construct this time series in necessity and discretionary across several macroeconomic dimensions. And we see that this pattern is not only related to consumption, but extends to other dimensions, such as employment, national accounts, and financial variables as well. So the second thing that we do is we look at where hand-to-mouth households are employed. So here we take data from the ECB, and we follow the definition of hand-to-mouth households from Zlaka, Elektristani, and Violante. And as you can see, out of around 26% hand-to-mouth households in the euro area, 17.5% are employed in the discretionary industries, while only 8.5% are employed by the necessity industries. So we incorporate these two features in an otherwise standard new Keynesian model. So the first thing that we introduce is demand non-homotheticity. So in the model, there are two households, one hand-to-mouth and share of hand-to-mouth and the share of Ricardian households. And they have identical utility over two consumption goods, necessity and discretionary. And the two goods differ because the discretionary good has a higher intertemporal elasticity of substitution. So the discretionary good is easier to postpone. But thanks to this equivalence result from the literature from Browning and Crossley, the discretionary good has also a higher income elasticity of demand, so it's also more consumed by the rich. The second feature of the model is that there are two sectors, and the hand-to-mouth households are more likely to be employed by the discretionary sector. So then the objective is to study what is the optimal conduct of monetary policy. So the two sectors are subject to symmetric cost-push shocks, and in the baseline, we calibrate the model to the euro area. And in the baseline calibration, the central bank follows a standard Taylor rule, where it responds to headline inflation. But then when we experiment with optimal monetary policy, we change the relative weight of discretionary inflation in the Taylor rule. That can go from 0 to 1. And we experiment with these different inflation bundles. So we then derive an expression for welfare, but I'm going to skip this for the interest of time. And so with this welfare loss, this is the first exercise that we do. So first, we look at the relative weight of the output gap in the welfare, depending on the model specification. So on the y-axis, you have the relative weight of the output gap in the welfare loss, and each bar represents a different model specification. So the light blue bar is the standard result in the literature that in a rank model, the central bank should put a low weight on the output gap. The yellow bar is another result coming from the literature that we replicate, that when you have hand-to-mouth agents, the central bank should put a bit of a higher weight on the output gap. However, this weight increases even more, up to almost 7 times the weight in the rank model, once you start having non-homotheticity, labor force heterogeneity, and both our features of the model. The second experiment that we do with the welfare loss is to look at how welfare varies depending, again, on the different inflation bundles that the central bank responds to, again, depending on the different model specifications. So here on the x-axis of this graph, you have the weight on discretionary spending inflation in the inflation bundle. 0 means that the central bank only responds to necessity inflation. 1 means that the central bank only responds to discretionary inflation. And each line represents a different model specification. So the horizontal bars tell us that in the rank world, in the model just with hand-to-mouth agent, and in the model without labor force heterogeneity, the welfare loss doesn't change with the inflation bundle. But once you start having labor force heterogeneity and both features of our model combined, the central bank can minimize the welfare loss within this set of Taylor rule, but by putting maximum weight on discretionary inflation. And so this result, in the paper, we do other exercises where basically we show that this result does not depend basically on differences in price stickiness heterogeneity across the 2 different sectors. So here in the baseline calibration, we assume the same price stickiness across necessity and discretionary. And we show in the paper that once you add the fact that discretionary sectors have higher price stickiness, as we see in the data, this result is stronger. So there is even more motive to respond more to the prices in these sectors. And second, we also do the same exercise with an alternative loss function, where the central bank does not care about the object that enter our loss function, that depend on our model specification, but care only about fluctuations in inflation and fluctuations in the output gap, in line with the central bank mandate. And we recover exactly the same result. So there is an allocative efficiency argument for responding more strongly to discretionary inflation in light of this new understanding of the business cycle and this combination of more cyclicality and more hand-to-mouth households employed by the discretionary sectors. So let me conclude. In conclusion, in this paper, we show that some of the assumptions that are assuming the canonical new Keynesian model, in particular, the fact that some sectors are more cyclical and also employ larger share of hand-to-mouth household, are violated in the data. And once we incorporate these features in a new Keynesian model, we show that the central bank can improve welfare if it responds more strongly to the inflation coming from these specific sectors. Thank you.
Very well done. So, questions? The timid reaction is very interesting in comparison to Sintra, where this paper created a shitstorm. So, okay, all the way there in the back. Yes.
Thanks, Chiara. Excellent presentation. Just one question you probably have in the paper, you didn't have time. So what happens, so when you calculate the welfare losses, these are conditional to which shocks that you have in the model? And second, are you looking at energy shocks, for example? These are, necessity goods, I guess, and they will be inflationary. So, yeah, what happens in that case? Thanks.
Thanks, Guido. Then we have Oreste.
Thanks, yeah. Just a small comment about the fact that in the euro area we also have heterogeneity across countries in, for example, the tourist sector and the size of the tourist sector. So I wonder whether you looked also at the cross-country evidence and or maybe you have plans to do so.
Okay, and then last question.
Great talk. I was, so there's a lot of literature thinking about sectoral heterogeneity and the importance, the implications for monetary policy. One thing, I mean, it was good. Well, one thing that I was wondering about was the role of input-output networks, whether you also looked into that and whether that could change your conclusions.
Good. You have the last word.
Okay, so starting from the different shocks. So what I showed you is conditional on symmetric cost-push shocks in the model. But actually in the paper we do also another exercise where we apply this McKay and Wolf methodology, where we can actually basically look at the welfare loss just using the data. And so this is basically robust to any type of shock that have hit the euro area in our sample period that we use for this methodology. And we get the same result that if the central bank was to apply our different rule, welfare would have been, the welfare loss would have been lower. So this is, in the model, this is just a symmetric cost-push shocks, but then we have also this exercise that, basically says that our methodology is robust to all the shocks that have hit the euro area in the last 20 years. Yes, then the countries, yes, absolutely, this is a very good point. So we don't do this in the paper because the paper is already, has already a lot of things, but this is absolutely, this has important implications for the transmission of monetary policy in the euro area indeed, because the composition of consumption across different countries is different, or the goods that are produced by different countries are different. So this could possibly be a second paper on this. And for input-output, so this is, I didn't have time to basically explain how we construct the data set, but we actually use the input-output tables for the euro area to define these discretionary and necessity industries. Because basically we start from a classification of goods, consumption goods, from the UK National Statistical Office. But then to classify industries, you need to take into account industries producing final goods, but also intermediate goods. And to classify them, we use exactly the input-output tables to see where they sell their products more, to necessity or discretionary. So that is already taken into account in the methodology. I'm not sure if that was your...
I mean, my question, if I may follow up, my question was rather whether my question was rather whether the theoretical, the predictions of your theoretical model change once the necessity and discretionary spending is also an input to the production of the respective other good.
So yeah, I guess the answer is then, okay, in the model we don't have that. It's more simpler. We have that in the empirics, and we see that so again, in the definition of the industries, and in the empirics we also do some other exercises to show that basically the transmission of monetary policy is so also when we identify monetary policy shock, the transmission is stronger to these discretionary industries. So it is addressed in the empirical part of the paper, but is not included in our model.
Good. Well, as always, room for more research. With that, great applause for